If you're using a bridging loan without a clear exit strategy, you're not investing, you're gambling. Let me explain why. So lots of people talk about how to get a bridging loan, but not enough people talk about how to get out of one. So let's go through what a real exit strategy looks like and how to make sure you don't get caught out at the end. I've done plenty of videos on how to take out a bridging loan, what they cost, how they work, and when to use them. But one of the most important parts of any bridging loan is the exit strategy, okay? And if you're going to take out a bridging loan, you need to be very, very clear from day one about your exit and how you're going to pay it off. So in this video, I'll walk you through the most common exit routes, how they work, and what to watch out for along the way, okay? The most straightforward exit is simply selling the property once the works are complete. In this scenario, you buy a property, refurbish it, and sell it on for a profit. Simple enough, right? But before you start, you need to be clear on who your buyer will be. Is it a first-time buyer, a home mover, or another landlord? As an example, if you're selling it to a landlord, you might design the property differently. You could set it up as a ready-to-rent HMO or a well-presented buy-to-let. And the key here, okay, is to tailor the renovation to your target buyer. Also, remember that the average time from marketing a property to completion is around 25 weeks, and this is according to Zoopla. So when you take out a bridging loan, don't just allow the time for the refurbishment, you also need to allow enough time for the sale itself. If the sale takes longer than expected or falls through, you don't want to be racing the clock to the end of the loan term. Running out of time can be very expensive, okay? So planning ahead is critical. The second and more common exit route is refinancing rather than selling. And this is where buy-to-let and commercial mortgages come in. So there'll be several options here, and the right one depends on how the property will be used. Let's run through the main ones. A standard buy-to-let mortgage is for a typical rental property, usually let to single tenants, a couple or a family on an assured short-hold tenancy, often for a 12-month period. And most lenders, okay, will go up to 75% loan to value, although some may stretch to 80% loan to value. A HMO, or a house of multiple occupation, is where a property is rented to 3 or more unrelated tenants, each paying rent on a per room basis with shared facilities. Lenders will want to understand who the tenants are, whether they're students, professionals, or mixed occupancy, okay? Most mainstream HMO lenders are comfortable with up to 6 rooms, while specialist lenders may go much higher, sometimes 10 or even 12 rooms. So when valuing a HMO, most lenders still use the bricks and mortar value. However, some specialist lenders will assess the property on a commercial basis, okay, where the income justifies a higher valuation. And this usually applies when you have 7 or more rooms and you're an experienced landlord. And the commercial approach can also allow you to refinance at a higher value and potentially release more capital, okay? You'll also have a holiday let mortgage, and this is for short-term rental properties such as Airbnb style accommodation. And these are assessed differently, okay? Lenders look at the projected income across low, mid and high season, as well as expected occupancy over the year. As long as the numbers stack, you can usually borrow up to 75% loan to value. A semi-commercial mortgage applies to a property that has both residential and commercial elements. A common example is a shop or an office on the ground floor with flats above. And typically, each part has separate access and different tenants, one under a commercial lease and another under a residential tenancy. As long as the rental income covers the repayments, borrowing of up to 75% loan to value is common. And finally, a full commercial mortgage applies to property used entirely for business purposes, okay, such as offices, warehouses, or workshops. You've also got commercial leases. These are a little bit different from residential ones. They're often long-term, sometimes 3, 5, or even up to 10 years, and the tenant is usually responsible for the repairs and maintenance. And most commercial lenders will go up to around 65 to 75% loan to value, and this is dependent on the rental coverage. So what happens if your exit isn't quite in place when the bridging term is coming to an end? And this might be because the refurbishment has been delayed due to labour shortages, materials or planning issues, and time is starting to run out. And the key here, okay, is early communication with your broker and lender. In many cases, lenders are open to extending the loan term, especially if you can show a clear plan and exit that is nearly there. If interest has been rolled up, meaning it's been added to the loan each month, the lender may allow you to continue if there's enough equity in the deal. Otherwise, they may ask you to start paying the interest on a monthly basis. Extensions can be useful, but there are a couple of things to keep in mind. You'll continue paying the interest during the extension period, and there may also be admin or extension fees attached. This is why I usually recommend taking out a slightly longer term at the outset with the option to repay early, rather than cutting it too fine, okay, and risking a costly extension. It's also important to touch on tax because this is an area that often gets overlooked. And before you buy, you should take out proper tax advice on how to structure the purchase. Should it be in your personal name or through a limited company, often referred to as an SPV? And the structure you choose affects how your rental income is going to be taxed. So whether you can claim mortgage interest relief and how much capital gains you might pay in the future if you ever sell. Tax rules have changed significantly over the recent years, so speaking to a property tax specialist early can save you a lot of money later on down the line. Once a property is purchased in one structure, changing it later can be very expensive with stamp duty, legal fees, and potential further tax to pay. Getting it right first time really matters. From a lending perspective, some lenders offer buy-to-let mortgages in personal names, some in company names, and some in both. And limited company mortgages usually come with slightly higher interest rates and fees, but for many investors, the tax efficiencies more than make up for that. As always, it comes down to your personal circumstances. Finally, let's briefly look at how lenders calculate rental coverage because this can vary depending on ownership structure. For example, a basic rate taxpayer buying in their personal name might need rental income equal to 125% of the mortgage payment, and a higher rate taxpayer may need 145% or more for the same loan. If the property is owned through a limited company, lenders often apply the lower coverage requirement, typically around 125%. So how you buy can affect how much you can borrow, not just the tax outcome. So those are the main exit strategies for bridging loans: selling, refinancing it into the right mortgage, or extending the loan if needed. And the key takeaway is to plan your exit before you take out the bridge. Be very, very clear on your timescales, your buyer or your lender, and your tax position. I can help arrange buy-to-let, HMO, holiday let, semi-commercial and full commercial mortgages. And I help clients structure their exit strategies properly from day one. Hopefully this has been useful. And as always, if you want to talk through a deal or need advice on your next project, feel free to get in touch.